So hello to all traders and welcome to another live engagement to the quarterly report brought to you once again by Orbex. Today we are looking at the third quarter of the year with myself, David, and our other expert market analyst, Daniel. Hi, Daniel. Thanks again for joining me today.
Hey, it's good to be back. How's it going, David?
Yeah, great. Thank you very much for joining me again. So we did a pre-recorded quarter report last time around, but we thought we'd give our traders a bit more of a one-to-one dynamic and give them a live session this time around. So what we're going to be looking at is the main points of interest in the last 3 months that have gone by in the second quarter, and what the probable scenarios are going to be for the next 3 months, and even actually going towards the end of the year, because it's not so far away anymore.
That's right.
Before you know it, we're going to be
Christmas is almost here.
Exactly. Before you know it, we're going to be in 2023. So we'll give, if we need to give a projection to the end of the year, it'll be fine. But obviously the next 3 months are the main talking points, because we've got things like earnings season upon us as well for a few of the stocks. So we'll get right into it then, Daniel. So what I'm going to do for the viewers, we're going to go through a few talking points and a few of the technicals on the asset list that we have. Obviously, any questions that you want to ask from your side, Daniel, and obviously from the trader side as well, please feel free at any time to jump in. And obviously, you can you can stop me from talking as well if it gets gets a bit too much.
Give you a bit of a rest. Yeah.
Exactly. So first of all, I want to look at the US index, because obviously we've had this big cloud hanging over not only America, but most of the economies, with inflation fears, recession fears as well. But the US dollar index seems to have taken got a bit of a second wind, really, because since the start of the second quarter in April, we've seen this momentous increase in the US index, and it's actually gone to a 20-year high, which is quite staggering if you think about what else is going on in the world. So, I mean, with America, Daniel, we're possibly seeing, obviously, less borrowing that the Fed wants to be doing, and it's on its third or fourth rate hike at the moment, with the focus on doing more by the end of the year. So where do you see the US economy headed in the third quarter?
Well, it's all pretty complicated, and I guess everyone's really waiting for next Thursday. Is it next Thursday? Yeah. No, this Thursday. I keep getting them this Thursday when we get GDP. I'm still behind by a week. After the Fed, and then immediately we get the GDP figure. Obviously, the Fed probably has got the number a little bit ahead of us, and it's going to tell us whether there's been two consecutive quarters of negative growth, which would technically mean a recession. But we already had that thing earlier today, late last night, when the White House is coming out talking about, well, actually, 2 quarters negative growth doesn't necessarily mean recession. It's the NFIB that determines, and so they're kind of like everyone's saying they wouldn't be making that kind of preparation if it wasn't already negative. And so, of course, Fed now projection is also negative -1.6. So that's pretty much, once they declare that there's a recession, that doesn't necessarily mean that the recession is going to continue. Now once it's established, then you'll have the market reaction, and there might be a chance for a rebound. But of course, the dollar gets a lot stronger when everyone's worried about the economy growing, and so it's not kind of surprising at all that that the dollar index has been going up. But one of the other things is, of course, is that the largest weight of the basket that the dollar is compared to is the euro, and the ECB hasn't been raising rates, while the Fed has been, well, since the April meeting, they've been raising rates at exaggerated clip. They're also expected to continue raising rates at 75 basis points, or 3 interest rates all at once. And well, the ECB finally did get around to doing their 50 basis points just recently, so that's probably why we had a little bit of a little bit of red there at the tail end.
A bit of a blip in the market.
Yeah, exactly. So then there's both factors there really pushing the dollar index going up. But now that might turn around a little bit, because now the big question is, okay, so the Fed's been raising rates. When are they going to stop raising rates? At some point. That's the big question. So there was a recent, was earlier today, they're seeing a study, I forget who it was, where there a number of calculations of where they expect there to be a peak. And before, it was the market was expecting the last rate hike to be somewhere in next year, and now it's been moved into this year. So there's probably a lot going to be weighing on the Jackson Hole meeting in August, because during the whole month of August, the Fed doesn't meet. They meet at the end of this month and at the beginning of September. So the September meeting, they might start pausing the rate hike, especially if you get a negative GDP number now on Thursday.
Of course.
So
Yeah.
keeping pushing rates higher after 2 months of negative growth might be challenging for them. So the question is, are they going to go full on to stop inflation, or are they going to start hesitating? They already hesitated during 2021. They were hesitating, and that's one of the reasons a lot of people are sort of accusing them of saying that because of that start and stop thing that they had going there for that whole year, the inflation sort of already got out of hand, and now it's going to take so much more to control it.
Yeah, indeed. I mean, like you just touched upon, with the ECB finally raising their rates, and the Fed have aggressively been raising their rates for most of 2022, with the ECB now and other banks starting to aggressively raise rates. That's why we've probably seen a bit of a nosedive in the last few sessions. We had this 20-year high not so long ago, but now we're seeing a bit of a correction. So a lot of traders did think that we were going to see a correction, but how far down do we go now? Do we go back down to the $100 level? I mean, it's quite a psychological level, and significantly it was not that long ago. I mean, if we look at the fact that it's the beginning of the second quarter, pretty much, where we saw
you're less than a quarter away.
Exactly.
Yeah. A pretty strong move. Yeah.
Exactly. So a lot of traders thought this was the big correction here, where we started moving lower, back down to to the $100 mark. But then we had this momentous push to the upside. So this was the Fed pretty much really aggressively raising rates. But now we're seeing a come down, like you said, the ECB and the euro does make up, I believe, almost 60% of the index. So with that being said, we'll see what happens in the near term. At least we've got another couple of months, obviously, until the end of the third quarter. But interesting times, Daniel. So thanks for your outlook on that.
Yeah.
And so we'll look straight on to the euro dollar. Speaking of a bit of a depression on currencies. So yeah, like we said, the ECB finally raising rates, widening the rate gap as well. And we've also had this parity that's been hit not so long ago, just touched for a brief day, I think, a brief couple of hours.
Yeah, and then it bounced off pretty quickly.
And then it bounced
really strong.
Yeah, so there's a very strong support there. So we saw this at the back end of 2016 when it hit the 103 to 104 handle, and then jumped up. If I just zoom out a bit, because I don't want to go too far back because of it was around this particular time here, end of December. So let's just say it just pierced the 104 handle, and then you saw this momentous jump. I'll just remove these drawings so it's easy to see. A momentous jump of like over 1,000 pips or something at the time. So, but since then, it has been, if we're talking about this last 3 months of the quarter, are we now seeing a similar thing now? Would you think there'll be a bounce and some support there due to the ECB raising its rates? Is the euro getting back on top, would you say?
Yeah, that's a good question, because that same bit that you mentioned previously was also, you had a separation of policy, because that was in 2017. You had the Fed started raising rates and the ECB stayed flat, and then the Fed had to reverse course. And so then, of course, the euro recovered substantially. So now the question is, what kind of separation in policy are they going to have? Because if the Fed effectively does start pausing in September, and the ECB continues hiking, then you're going to have the spread starting to close, and so then the euro could bounce back up. But if it is actually a recession and ends up being kind of a strong recession, it might be that most traders are not going to be really all that interested in staying in the shared currency, because it's a little more shaky, and they prefer a more solid dollar. And then we could come back down to parity and then push through it. So we're still missing a few data points, which we'll probably be getting over the next couple weeks to really see where the direction is going there.
Yeah, definitely. So it'd be interesting to see that if this support does become a bottom, let's say, for the euro dollar, if we're going to see 1,000 pips move to the upside because of that. So we'll see if that comes into fruition.
I mean, it definitely is possible, because the situation that we had in the first half of the year is most likely going to kind of revert, because in the first half of the year everyone was sort of still kind of positive, and then now we're getting all the collection of data so that they might, now that the ECB is finally taking their move. But also the other thing is this, the TPI, or the anti-fragmentation thing. They keep changing the name, and then keeping track of all those ECB acronyms is always a little bit difficult.
Yeah.
Where they're going to essentially be buying bonds in one section and selling bonds in the other, trying to keep the periphery and the central interest rates kind of similar.
Yeah.
That could end up causing more weakness for the euro, even though they're actively raising rates, because the normal mechanism for dealing with inflation is that you let interest rates go up, and then the amount of money in circulation slows down. And so the problem is that there's more. The reason that interest rates are higher in the periphery, one is people have less confidence in the periphery, but also because the inflation rate is higher. Spain has the highest inflation rate in the eurozone, for example.
Okay.
So naturally, their interest rate should be higher. But if the ECB is knocking that interest rate down, you're not going to have as much correction. And so if they're trying to control inflation, where they really need to control inflation is in the areas where you have the most inflation, which would be in the periphery. But their mechanism actually doesn't help with that. So you could end up having a higher inflation, even though the ECB is raising rates. And then, of course, inflation deteriorates the underlying value of the currency. And if the US does get their inflation under control, as hoped by the Fed, or if there's a recession, that would also presumably lead to a reduction in the inflation. So then it's not just the interest rate spread, it's also how much the currency is worth and how much you're losing from inflation between the two of them. And so if you could end up in a position where the Eurozone has a higher inflation rate than the United States does, and so then that could also push the euro down below parity again.
Yeah. That's
a little bit speculative there, but
it is, but it's a possibility. And actually sticking with the European theme, okay, we've got this Brexit embargo still going on with the pound, but it's not in the European Union anymore, but it is part of a European state. So we have to just take that into account when we are seeing the pound, cable pound dollar be on the same trajectory really as the euro dollar. The charts are pretty much the same now. We've got really high inflation in Britain. I believe it's at a 40-year high. Obviously, there are other countries experiencing the same duress, like you just mentioned. You gave a few examples, but with the UK, we've had so much turmoil in the last few sessions, and we've got the Bank of England, most interestingly, trying to kind of stem the tide. But recent reports said that inflation could actually jump up to 14-15% by the end of the year, and that's a scary thought if you think that. Like the euro dollar, we did see a bit of a bottom here at the 118 handle, and a bit of support, but that could be short-lived if we've got all these inflation fears and the Bank of England not really acting upon it straight away. Do you see the Bank of England really aggressively approaching that?
They might, but the thing is, they've had plenty of reason to do it before, and they still haven't. You keep getting these three dissenters that want to raise rates more, and they just keep going at a slow 25 point and 25 point, 25 point. And if they're looking at inflation of potentially up to, like, they keep raising rates and inflation keeps going up. So it's like, guys, you got to do a little bit more.
So need to change the plan here.
So, I mean, they might finally get around to doing that. And also there's the recent problems because generally politics doesn't really affect all that markets all that much, but there's a certain amount of uncertainty because the current prime minister, we don't know. We know he isn't going to be around all that long, but he isn't going to be doing all that much changes, and so there's a little bit of uncertainty about what could happen. Well, even though it's already been pretty much narrowed down, between Sunak and Truss, who have pretty similar policies in mind. So there isn't all that much uncertainty, but still it's like the main issue is the relationship with the European Union, which is also creating a little bit of friction that's sort of been put on pause while the main negotiator from the UK is busy running her campaign, essentially a campaign to be prime minister. And so there's that level of uncertainty has been put in, and it's probably going to stick around at least for another month, because when is September 4th, if I remember correctly, that you get a new prime minister, I think it is.
Yeah, I
Or
think they
the
go
start of
on.
September.
I think they go on a summer break soon, the Parliament of the UK. So it's probably just in time for them to cool their heads and then come back for a vote. But yeah, I think it wasn't really affected too much, Cable, by the Prime Minister's
Yeah, yeah, I wouldn't expect
resignation.
it to be much all that much, but with a
Yeah.
little bit of uncertainty, and it's sort of like the markets are on edge, and so any little thing that comes along, they could just go and like they have a little bit of an overreaction, particularly onto the downside.
Exactly. So, I mean, keeping again with the European theme, we'll move on to the Swiss franc now, the dollar Swiss franc. Now, we've had the Swiss franc being a so-called safe haven for quite a number of years, but is it still a safe haven, would you say, in this time of uncertainty? I mean, just to go on the chart quickly, since the beginning again, well, almost the beginning of the second quarter, we've had this very choppy judgment on the dollar Swiss, and a lot of traders did think that we'd hit this double top again to test, because it's almost a near perfect double top. Just move the things out of the way. But we got to this particular area here. Obviously, we've started the third quarter now. It seems that a lot of traders have just had a bit of a sell-off and been a bit uninterested in the dollar's strength over the Swiss franc. So, could you say that it is gaining some ground again over the dollar due to recession fears, inflation fears, these kind of things?
It could be, but it also has the issue that it's backed by gold, and so if there is kind of like a shortness in liquidity, you could still have the same phenomenon that we had way back in 2000. Well, way back is a little bit of it, back in 2020. When you had the pandemic crisis, there was people needed money, and so you also had gold go down a little bit, and then also caused the Swiss franc to go down a little bit. So it is still a safe haven, but with sort of like a caveat. If you want something to put your money into to hold in cash until the market finds a bottom and then jump into it, which is what most people seem to be doing right now, because if you look at the reverse repos and that the Fed has, they're at record levels. So it seems like everyone's hoarding cash, waiting for the moment to jump in. So it might still be, the question is are people going to be really selling gold, and that could push the Swissy down a little bit. But also the S&P has also changed their tune a little bit, which is why you get that big choppy thing there. Previously, they were just trying to keep the currency somewhat pegged to the dollar, not really pegged, but sort of in this range close to where the dollar was. And then after that, they sort of, now that the Fed is aggressively raising rates, and the S&P doesn't really have to, because Switzerland, because they're based on gold, doesn't have such a terrible problem with inflation. It does add a little bit of stability, but that's why you can see there's more choppiness, but it's actually kind of more stable, because it's the comparative that's moving around a little bit more. I don't know if I'm really explaining that.
Yeah, it's fine. Yeah, I mean, from a trader's point of view, we're just basically looking at what the opportunities are, and obviously the Swiss franc has always been this kind of like safe haven asset, bouncing off gold. And if there is recession fears in Europe, I mean, is it going to hit the Swiss franc quite dramatically, would you think?
I would expect it to be more volatile, actually. It's kind of like similar to what we had recently, because people are sort of like, should I get into the Swiss franc and hold on, or should I jump into the market now, or I should hold back a little bit, and I should jump in? So you'll get that increased volatility, I would expect. And of course, there's always the thing of because 20% of the Swiss franc is based on gold, you always have the relationship to gold, and I would also expect that to fluctuate a little bit too as well. So I mean, it might be really, for traders, of course, these ups and downs are really good opportunities for getting in some pips. So actually, the Swissy might be something interesting to look at, but you also have to be a little bit more careful than normal, because before you just put your money in the Swissy and not really worry about it, now you have to like pay a little bit more attention to it, like another currency would, I would guess.
Well, yeah, exactly. I mean, just going back to this particular day here, 16th of June, we saw a dramatic, this is in one day, went from almost $1 all the way down to 96, in the mid 96 range. So quite a few pips, over 300 pips being wiped off in one day. So yeah, you have to.
Yeah, that's something you would normally it was seeing, a cross, not in the
Yeah,
Swissy.
exactly. So, okay, interesting things to look at there, Daniel. Thanks for that. So, moving
Mhm.
on to the other side of the world now, we're looking at the yen. The yen has been pretty much crashing against the American dollar. I mean, we've had the Bank of Japan keeping their main base rate in a negative still. At
Yeah.
minus 0.1, and obviously that's kept, well, it's not really so much of a reason, because obviously the Bank of Japan has had this rate for a long time, but for the yen to be at a 24-year low against the dollar, is that a bit disturbing? Would you say it's a bit of a worrying time for the Japanese yen?
Well, it seems the Japanese are starting to get a little bit worried about it, because they're starting to talk about, 140 as being the top. Sorry,
Yeah.
for the top for the yen. So it was always a question of at what point would the BOJ step in to do something about it, because if it keeps weakening, it ends up having some impact on the domestic market, particularly. Japan imports most of its food and its energy. So those are also the things that have most increased in price lately. So now they're starting to get potential problems of inflation, but it's not the kind of organic inflation that the BOJ would want to see.
Mhm.
So yeah, probably getting close to near where they might let it go. Maybe up to 150 they might let it go. It's right now, it's just a matter of, I would say, as far as the BOJ is letting the currency go before they go and start intervening to push it back, because it's starting to have an impact on their inflation, which is really what they're going to be particularly worried about.
Exactly. Yeah. I mean, I was just trying to pull the chart back to 24 years, but I couldn't get there. But I mean, it's the last time we saw this, it was such a long time ago, and obviously in the bad times of when there was a recession, another recession in the 90s as well.
Yeah.
So
Yeah,
you know,
that took coordination with the United States. Also, they just came in one day and said, okay, we're not going to let it go any further, and they put in a whole bunch of money to restore it. So it's sort of like they're just letting it go to a certain period of time, and then at some point they're going to say, no, it's gone too far, and then the hammer is going to come down. So it's kind
yeah.
of like, it's a little bit of a risky bet to bet that it's going to keep going up, because it's not really, something like technical or fundamental. It's just up to whenever the Karuda or the prime minister comes up and says, okay, it's gone too far, we're gonna stop it now.
Yeah,
Where that
exactly.
is, we don't know.
I
It's,
mean, yeah, but I mean, I heard that the 140 region would probably be a top. I mean, we've seen a little bit of resistance here and a bit of a price come down here, trading at the 136, mid 136 range now. So,
yeah,
um,
I would kind of agree with that too.
yeah,
Because I also heard similar, but it's not an official policy. You hear like someone in the know, someone who's familiar with the matter or something like that,
yeah.
and it's like, well, okay, how familiar is he? So then, but you don't want to really bet against someone who's in the know, as it were.
Insider information, probably something
Yeah.
like that. Okay, then great. So we'll switch over to the other side of the world now, going to the commodity currency, the dollar CAD, or the loonie, as what a lot of traders know it as. So
Ooh.
obviously, oil prices do tend to move a lot, or well, the Canadian dollar a bit. Obviously, it's a big exporter of oil as well. But not only that, the Bank of Canada as well. I know I know we're highlighting central banks quite often on this, but they are basically giving us an insight to the next 3 months as well, especially with raising rates and things like that. So, do you think the Bank of Canada seemingly have adopted a similar approach, like the Fed, with aggressively raising rates? Obviously, they are their neighbors and everything. So, what do you think going forward for the Canadian dollar? Is it a worthwhile investment? Is oil demand going to affect it? Because obviously, with Europe getting cut off from Russia by the end of the year,
Oh, right. Yeah.
obviously we're going to go on to oil shortly on the actual commodity. But do you think the Canadian dollar is going to be affected by that as well?
Yeah, well, the thing, because there's so much trade between Canada and the United States, it's kind of understandable that the Bank of Canada is going to kind of maintain a similar policy with the dollar,
Mhm.
well, with the other dollar, because they're both called dollar. So it might be an alternative for a little bit more volatility if you don't want to just go and get stuck with the American dollar. The
Yeah.
Canadian dollar is likely to follow a similar path as the dollar, so you might end up getting less volatility because because Canada is facing a relatively similar situation economically as the United States. It would also be expected that the Bank of Canada is going to have a similar policy as the Fed. So that would be one way sort of to insulate these moves that you get from the central banks, since the two central banks are going to be moving in tandems, and then you're going to have kind of like more underlying factors. But then of course you have the price of oil going up, and so the question is the price of oil going to remain high? And then that leads us into the issue of it's geopolitics. It's not really up to supply and demand. It's up to whether someone who has control over a large portion of oil decides to start selling it, or decides to not let production increase. And so again, that makes it really hard to forecast, because you're trying to guess what someone is going to decide to do, as opposed to where the market fundamentals are going.
Yeah, exactly. I mean, if we're just looking briefly at the technicals now, I'm just doing it from the beginning of the second quarter, so it's a little bit easier for traders to get a grip of. But at the moment, we've seen this choppy action and another test to this kind of upward channel. So, I mean, there is an expectancy that it would drop. It's at the trading at the mid 128 at the moment. It would drop possibly to the mid 126, so roughly about 200 pips. But I mean, that will be over the course of the next few weeks, and we'll see if we get another test to the downside here. But yeah, I mean, the Canadian dollar is still kind of holding its own against the American dollar, not really going too much in the way of the American dollar, as we've seen in the past.
Yeah, but there's something, I don't have the Bank of Canada schedule memorized, but there might be something there to do with the difference between when the Bank of Canada meets and when the Fed does, and you get that sort of up and down movement.
Yeah,
maybe. Be
yeah,
something to look into, actually.
There is a correlation, yeah, definitely. So we'll see how that plays out. So
Yeah.
we'll just briefly jump over the border now and go to the Dow. We wanted to highlight one of the main indexes of the American market. So that the Dow has been, because it's only 30 companies that's making up this index. It's easier to be a bit more choppy, to be a bit more hit, rather than the S&P 500, for example. But since the start of the second quarter, we've seen quite a decline from the peak of 35,000 that we've seen in the recent 3 months. So, I mean, we've still got this, supply chain issues along with price inflation as well, and obviously, industrial reporting's higher profits. But what is any money being injected into the American economy due to these things now? The aspects.
Well, that's kind of the problem. Well, I mean, most of the stocks have been going down, of course, because the Fed's been well, at the beginning of the year, they were still putting money in. So through the course of the last quarter, they finally started taking money out. And so, of course, we can see that, but that would naturally affect the stocks. But of course, the Dow doesn't have very many tech stocks, which are the ones that have the higher valuation. So the thing about the Dow is that previously, since it was mostly industrials and people were already worried about supply chain last year, you didn't have this strong run up that you had comparatively, say, for example, the NASDAQ. Yeah. So because you didn't have such a high increase, it's also kind of expected that the Dow wouldn't have such a large decrease. And so it also, at the beginning, there was this shift from tech stocks into value stocks. But then again, that goes back to the thing that I mentioned previously with the repos, that people are holding a lot of cash outside of the stock market, even though there's even cash being taken out by the Fed. Also, traders are taking cash out. So it's kind of like there's a downward trend. And then, well, for so far this earnings season, the companies have been reporting better results, but on lower volumes. So they're selling more in terms of cash, but the amount of product that they're selling is less. And that is a sort of a function of inflation. And so they have better, they're making more profit on in nominal terms, but in real terms, they're making less profit. So I think it's like 80% of the companies that have reported so far, but that's the S&P 500, not the Dow, have reported lower profits than the prior year if you consider inflation, even though most of them are showing higher results. And so the index is going to have to reflect that at some point.
Well, yeah, I mean, you touched on the S&P as well. It's pretty much moving in tandem with the other indices as well. I mean, they're having a bit of a hard 2022 so far. I mean, I'm looking at the Dow now from the beginning of the year, January, and we had a peak of just almost 37,000, but since then we've had a low of, well, we spiked under 30,000. So with this kind of respite here that we've seen in the last few trading sessions, a lot of traders are expecting it to be a little bit of a flash in the pan. If you know that expression, basically we're just looking at a little bit of an upside, but then a correction. And if we do break 30,000 again, we could be in for really fresh lows that we haven't seen, well, since the back end of 2020 when the pandemic was really upon us. So a bit worrying for the American market, but trading CFDs there are good opportunities as well with the sell side of trading.
See,
so
that is the definite advantage of CFDs, that you can short the market. I mean,
exactly.
Actually, I don't know if it's really visible. It might be like a line that the Dow is getting up close to another peak before it moves down in the next couple. That might be following the Fed meeting or GDP data. We might see the next move down, like it kind of crawls up and then drops, crawls up,
exactly,
drops. And now we've been crawled up through all of most of July, and now, well, at the end of July, we might see another move to the downside.
Exactly. And not to mention the NFP, I believe, is next Friday. We're going to
right.
So so again, another
There's
thing
plenty
to
of
think
data
about.
there to move the Dow.
there is definitely. So moving swiftly on to a lot of traders, what's on a lot of the tips of their lips is gold, because from the back end of Q1 moving into Q2, we saw these fresh highs close to, well, above 2,000 and close to testing 2,000 again. But since then, reaching the 1,700 mark, and it's kind of a $3,000 drop in the course of a quarter. So would you say it's bears are fully in the market for gold?
So far, yeah, because the Fed has been really pushing up rates, and as long as they keep raising rates, you would expect people to be more interested in buying treasuries than they would in keeping money in gold, because gold doesn't pay interest, but treasuries do.
True.
So, but then of course that could come to an end, if we get a negative GDP, and then everyone starts thinking, well, September the Fed isn't going to raise rates, then you could see gold moving back higher. Is people, if you get people really going on about recession, probably the NFIB isn't going to technically say that there was a recession, but pretty much everyone's going to, if it comes out negative, if the GDP comes out negative, everyone's going to probably feel it and act like that. So then they might be starting moving back into gold. There might be an interest to move back into gold, and then we could get a move higher. But also another thing, last year, there's a lot of people buying gold because from retailers. They were pushing up the price of, not retailers, sorry, retail traders were pushing up the price of gold because they had extra cash available. And then, well, now we're not getting any kind of stimulus, COVID stimulus. So that could also put a little bit of extra weight to the downside for gold. And of course, there's China. China's the second largest buyer of gold. And they don't have very much, because of all their internal problems. They're running out of the most of the people that buy gold have less money available to be buying it because of their housing crisis. So there's another reason for gold to not potentially move up as high. But then of course, gold is measured in dollars, so it's a matter of, if the dollar continues to have high inflation and if the Fed kind of gives up on going after inflation, then you could see gold moving significantly higher.
Yeah, well, something that's going to tie into our next instrument, which is oil, is the Russia-Ukraine tensions, and also the fears over ongoing lockdowns as well as we go into the back end of the second half of 2022. So we've had lockdowns in China, which affected a lot of markets quite significantly. Obviously, these spikes here that we saw, this was at the beginning of the conflict of Russia and Ukraine, and then we saw another one. But since then, it's kind of calmed down. But it's still ongoing. This Russia conflict is not going to end anytime soon, most probably. And also with COVID, a lot of countries COVID infections getting higher and higher as obviously lockdowns are not around anymore, and obviously face masks are not really pushed anymore. So could you see maybe further lockdowns in 2022? And obviously, would this Russia-Ukraine invasion, this conflict that's still going on, can this affect gold going into the second half?
Well, for the Russia thing, there was this idea for going around for a while that because Russia was cut out of SWIFT, they would be forced to start using gold, and that would push up the demand for
That's
gold.
right. Yeah.
But that seems to sort of gone by now. Russia essentially defaulted, and they're saying that they didn't because they have the money. They're just not being allowed to use it. But the thing is sort of functioning, and so that particular worry seems to have gone away. Hence, gold has gone down a little bit.
Exactly.
But that doesn't mean it can't be revived at any point, because you could get, in increasing tensions. They just had this agreement about exporting grain, and then the very next day they went and lobbed some missiles at the port that they're supposed to be exporting grain from.
Exactly.
And so
Yeah.
you never know. Whatever happens, there's just something always can get in the way,
Yeah.
and it's often deliberately from from particularly the Russian side.
Of course. Yeah.
So you can always have a sudden risk on thing. They could open up a new front, and then suddenly everyone gets worried and then wants to start buying up gold. But then as for the lockdowns, that might and they were significantly negative for the economy previously. So there's a strong incentive not to go back to lockdowns. But there could also be a strong political incentive to do it, because people might start getting worried, and so it also is an extra risk. But the issue with the lockdowns there is because when they had lockdowns, people had extra cash because they had the stimulus payments, because people weren't able to go to work, and that extra cash is what also helped push the markets, including cryptos, etc. So it's not just a matter of lockdowns; it's whether or not, if they do some kind of lockdown, and then they also comes along with some kind of stimulus. And people probably wouldn't be all that interested or supportive of lockdowns if there isn't an extra stimulus attached to it, and that could also affect the market. So the different speculative points there.
Exactly. No, it's very good to hear all the points about it. I mean, I've just highlighted the 1800 handle here because, within a couple of days, just as the third quarter started, we had a crash through the 1800 handle and all the way down. And this is in 2 days. We had like a $60-$70 move. So, I mean, that could easily be rectified. And this $60-$70 move to the upside could easily get back up to the 1800 handle if it does go, if the bulls do start entering the markets for gold again. It is reasonable to think that.
Yeah, it seems to be kind of like the stability level, if you consider previously, before it was interrupted from the Russia thing, and then with the Fed really pushing rates. And so if the Fed starts reducing the amount of rates, instead of going 75 basis points, it goes back to 50 or 25, then there's more chance for gold to move back up to 1,800. There was a couple of companies that I was doing. I think they were mostly Canadian companies, and like almost all the companies that I was doing that were reporting their earnings recently, they all had like $1,400, $1,500 as their cash cost for producing gold. So
Right.
if it goes to that level, there's kind of like a bit of a floor there, because if it goes down, then it stops being the companies stop making money producing gold, and so they're going to slow down their production.
Right.
So that's another factor. So
okay then. Well, yeah, like I said, tying in with the gold theme, oil as well, American oil, crude oil, that being, I mean, it has actually obviously been affected by supply and demand fears. Again, we've got the Russian invasion of Ukraine at the peak here, when it peaked above $128. Since then, it's been on a bit of a choppy ride, a little bit indecisive, but now we're seeing a few levels that we've seen at the previous bottom when the Q2 did begin, roughly about the $94, $95 level. So, I mean, okay, taking Russia away from it, out of the equation, what else would you think could start moving oil in the next 3 months? It could be an OPEC situation. Could it be something else with recession fears? Could we see another push?
Yeah, I think you really hit it with the recession comment.
Yeah.
It seems to be what everyone's really considering, and why gold would, I mean gold, why, well, black gold,
Black
why
gold,
oil
yeah,
is going
true.
is going on going down a little bit, because the recession means lower demand. But of course, there's always been this problem of increasing production. There seems to be a disconnect between the amount of demand and the amount of production. And then also this factor of how much can Russia get around the sanctions, because
Yeah.
there's a bunch of countries that are willing to buy Russian oil. They're not really participating in the sanctions. And so if they start buying Russian oil, then the oil that they previously buying would come out, it would be available to other customers who are not buying Russian oil. And so because of the logistics, it's a little bit harder, because Russia had all their everything designed to export oil to Europe. Well, now Europe isn't buying, so now they're going to send to China. Well, it's going to take a while to build the infrastructure to send to China, and then China used to be buying from the Middle East, so now the Middle East isn't going to be selling to China as much. Who they're going to sell it to? They're going to sell to Europe. So now they have to have their infrastructure reoriented. So that'll take a little bit of time. And then once that happens, you'll get more price stability, because the market will rebalance, presumably, assuming that there isn't like another war or recession or an asteroid, or any of those other things that
Yeah.
can come in and change things. But I remember, before the thing, the Russian thing started really getting worrisome, which was like, what was it, early December? Oil was getting up close to somewhere around 80 per barrel, and it was like at that time it was considering that 80-90 was the peak pre-Russia. So without the Russia thing, oil would probably be closer to that level. And so if we're getting down to $90 per barrel, it might mean that the market is kind of rebalancing out and getting rid of some of the effect of the Russian conflict.
Yeah, I mean, I've just highlighted the $100 barrel mark just because it's been kind of floating around there for the past few sessions, and there's a bit of indecisiveness as well, whether or not we're going to get a confirmation and a push above the 110, let's say, for example, because that's where we saw the last cluster of pricing. But yeah, touching on those subjects as well with US oil, we have to just think about it's kind of obvious though, isn't it? I mean, it's good for traders because obviously recession is going to hit supply and demand. COVID lockdowns is going to hit supply and demand, as we've seen in the last 2 years of the pandemic as well. But also, just wanted to touch upon natural gas as well, because again, this has been the amount of supremacy it's had in pricing for natural gas over the last since the beginning of the year. It's been extraordinary, actually. We've seen it almost hit $10. It has fallen dramatically since then, as you can see here, but now it's shaping up. If you see all these green bullish candles, and this is only from the beginning of July, really, it's not really been that far away that it's actually on a trajectory now that it could hit this previous top that we saw, or roughly about that kind of thing. So with natural gas, does it tie in with the whole oil scenario as well, and the Russian Ukraine crisis as well?
Yeah, it's pretty much I say it was with the Russian-Ukraine situation. Like, it started moving up higher basically at the start of July, when it was announced that the Nord Stream 1 pipeline would have to go into maintenance, and everyone was worried that meant that there's an excuse to suspend production. And now just recently they got some of the paperwork for one of the turbines, and there's some kind of problem with the paperwork. People really don't know what that means, that there might be another shutdown because there's another maintenance period coming up. And there's an issue of getting all the parts for it, and with Russia being under embargo, that either provides an excuse for not sending oil, or B, just even if they do want to send oil, it might mean they might send natural gas. And the other thing about natural gas is you're going to probably have a lot more volatility, because it's harder to move natural gas, because mostly it's sent in compressed pipelines, and those take a long time to build. It's not like crude, where you can fill up a tanker ship and then just send it to someplace else.
Of course, yeah.
You can't do that with it. So you're going to get much more volatility with natural gas, I would imagine, particularly around the Ukraine crisis.
Yeah, exactly. And as we said, because it's probably not going to stop anytime soon, we might see more fresh highs. But I mean, good opportunities for traders as well if they're looking to buy. I mean, if you saw this particular area here bottoming roughly about the mid $5.50 range, then you could easily have put in a buy position, and you'd be making some steady profits at the moment. So a lot to take into account with basically with gold, oil, and gas. I mean, they're all kind of moving in a way where the conflicts, the pandemic, the lockdowns, they're all kind of tied in to big movements actually in these instruments as well. So
yeah, the good news about volatility for us is that it means good trading opportunities.
Exactly. So it's been pretty good going so far for a lot of bulls in the market, that's for sure. So moving on to an instrument now that we haven't covered before, because we just started offering it, is Bitcoin. And
Ooh, right.
a lot of there's always been volatility with Bitcoin. I mean, it's just part of the trading
It's
Bitcoin
nature.
basically. Yeah, exactly. It's like the circle of life basically. There's always going to be volatility. But if we look from the beginning of the year or the back end of 2021, we saw this recent peak, almost towards $68,000. But since it's been the course of the second quarter, at least since the beginning of April, we've seen this almost a 40% drop off in prices. It has seemed to apparently found a bit of a bottom at the $20,000 range. We did actually break the $20,000 for a few times here, as you can see, but it has found a bit of a range, and now it seems to be pulling away. The last few sessions have seen some red bearish candles, which gives the indication that we could be seeing a test at 20,000 again. But what are the main drivers of Bitcoin, would you say? I just want to touch upon that. We did see Tesla sell off most of its Bitcoin purchases the last few sessions, but I mean, it hasn't really affected the market that much because it is still in a range at the moment.
Yeah, that was one of the things that people were saying, that Tesla or Musk is kind of manipulating the market a little bit, and like you have these big buyers that could move, and then it turns out that Tesla sold almost $1 billion worth of Bitcoin, and it didn't really move the market all that much. So I think that was there's kind of, I guess, counterintuitively would say it's something of a bit of a positive thing, because it sort of returns a little bit of credibility to the market in the sense that it's not really, you can have people buying and selling, and it doesn't really move the market all that much, and so it responds more to fundamentals and technicals. But I would expect the biggest driver here really is the Fed, because investing in Bitcoin is a high risk proposition. Essentially, you have this significant amount of volatility. So if people are worried about getting into the markets, the thing that they're going to be most worried about getting into is Bitcoin. And so if you have higher interest rates, it's going to be harder for people to leverage and to borrow money to buy into Bitcoin. So I would expect that as long as the Fed is keeping rates under pressure, then you'd have Bitcoin probably trending lower or trying to find a bottom. But of course, the upside to that is that there's a whole bunch of money in reserve, so that at some point when people think that, okay, now the Fed isn't going to keep raising rates, then you could see Bitcoin really bounce off of that and move up higher. Question is, where is that bottom? That's the big problem of figuring out.
Well, I mean, a few traders were saying that there was a bit of a range between the $19,000, $22,000 range for a while, until it recently broke out just a few trading sessions ago. But it seems like it's kind of sinking back towards, just highlight the 22,000 just so it's easier for the traders and viewers to see. So yeah, between 19,000 and 22,000, it was trading for a while, as you can see, like getting some firm support and resistance. Broke out in the last few sessions, but as you can see, it seems to be falling back into that reverse now. So it'll be interesting to see if the $19,000 to $20,000 was the bottom, or if we're going to get well, I mean, if we pull this right back, we didn't see these levels since the back end of 2020. So before that, obviously, it was in its infancy of this big trajectory that we saw as well, these record highs of Bitcoin. But, it is in a little bit of danger of being sucked back into this kind of continuation pattern. So it'll be interesting to see, like the things you just highlighted, Daniel, about the Fed and about the other factors that can possibly shake up Bitcoin. So
yeah, it does seem like it's like taking steps down. It goes flat for a little while, then down, and then flat, and then down, and then maybe this is
exactly.
like another flat, and then
Yeah.
no, it's going to go down again, or it's gonna rebound. At some
Exactly.
point, I would expect it to hit a floor, but I mean, if you consider further back, it was, I think it was like at 10,000 before you get this massive move higher,
Hmm.
from which was a combination of the Fed drastically cutting rates and the stimulus payments. That was what really pushed uh, Bitcoin up like 6 times what it was previously. And
Yeah.
so it might have to go all the way back down to 10 and then get the rebound, or it might be at the position now. So I guess a lot of it really depends on what we get from the Fed. And maybe we need to be a little bit more patient until September, see how things evolve, and
Well,
what happens at the Jackson Hole meeting.
of course, yeah, and I can see it going below 19,000. I don't think it would be such a surprise for a lot of traders, but obviously we'll see what happens with the big stories coming up in the next few months. So now, Daniel, on to the final part of the report where we look at stocks, and we picked
Ooh,
out
right.
a few stocks just that have been in the headlines, and just going into the Bitcoin story as well. We highlighted Tesla there, and Tesla has been kind of a little bit subdued, especially if we just highlight when the third quarter started. Sorry, the second quarter started, the beginning of April. It's literally lost quite a lot of value in that respect, but it has had a bit of a jump in prices in the last few sessions. And this also ties in with a story with Twitter, which is another stock where it pulled out of its acquisition, which actually made their shares jump by over 3% on the news, because obviously they're going to have more money to invest in Tesla now, rather than this $44 billion takeover that Elon Musk did have lined up. So we're kind of plugging two shares at the moment, Tesla and Twitter, due to the fact that they tie in together. So, I mean, were you surprised that Elon Musk pulled out of this $44 billion deal to buy Twitter?
Not really. I mean, Twitter's kind of pretty obviously overvalued at $52. No, sorry, $54
Yeah,
and 20 cents. It's way overvalued. So it seems like more like, here, I'm going to offer you this to get you interested and start the negotiation, and then like now we're going to offer. Then we're going to actually have the full discussion of how much it's going to be.
exactly. Yeah.
So I would expect that to go on for quite a while. So the other thing is that the Tesla's move to the downside they'd starting with during the last quarter kind of coincides with what the Fed was doing, and Tesla, has a very high valuation. So
Mhm.
if you're buying Tesla, you're not expecting to get a dividend off of it. You're expecting the price to move. So that's going to really depend on whether there's funds available. So if the Fed is hiking rates, then the shares of Tesla would be kind of under pressure, and we're waiting for people to come back with funds to really buy into the tech stocks. And so also Twitter is another tech stock, but the difference between Tesla and Twitter, of course, is that Tesla generated profit and Twitter hasn't.
Yeah.
And so then I don't know. Twitter seems to have some like internal issues that it needs to resolve, and it depends on what happens in the court case, and what kind of information comes out there. We could see some significantly more volatility in Twitter shares. So it's sort of like Twitter is something if you're going to be trading in Twitter, you probably want to be paying really close attention to the headlines
Yeah.
instead of being more technical. Whereas with Tesla, it's sort of like has a technology that a lot of people really like, so it would probably trend to the upside, and also it's generating profit.
Hmm.
And they have the two new factories. Two new factories are still generating a loss because they're still not fully up to production.
Hmm.
The newest ones being Berlin and the one in Texas, because the one in Shanghai is already generating a profit. So the question is, are those two factories going to start turning a profit in the next quarter-ish? And if that were the case, then you'd see an increase in the valuations of Tesla, and so Tesla could start moving higher. But still, it's still a kind of significantly the valuations are still way off the chart.
Yeah.
So the market cap of Tesla is way more than any other car manufacturer that produces way more cars. So
Hmm.
it's still based on what people expect to happen in the future. But there's still some more, like this seems to be more base for Tesla to grow than there is for Twitter to grow.
Yeah, like you said, it is a little bit overvalued, especially with Twitter. Just looking on the charts now, it's quite, no, how to say, a little bit funny, let's say. I mean, when we did get the acquisition news about Tesla and Twitter, we saw this big jump, big gap in the market, a big spike up, because with every acquisition or any rumors in the market, such as when Amazon were going to buy Peloton, or Activision Blizzard were going to be purchased by Microsoft, we saw these big jumps in the market on the stock. And then they slowly kind of like, you know, when traders realize, okay, it's moving a bit slow, we're going to a bit of a sideways move. But then when the acquisition wasn't going according to plan, we saw the drop in the market. And then recently, this is when it was called off, just at the beginning of July as well. So, you know, the stocks do move quite a lot on these kind of big acquisition purchases, but with Twitter, it's been a bit detrimental. They have actually bounced back from the recent, just remove some of these drawings, it's a bit easy to see. They have bounced back from the recent, you know, no go from Elon Musk or Twitter or Tesla, where they said that they weren't going to buy the company. But now, obviously, Twitter are trying to sue Elon Musk as well. So their shares have kind of bounced back, but obviously, it's going to be a long time before they can get back to the dizzying heights of over $50 on their stock value. But where it is now, it's probably, you know, a little bit more realistic, because this is where they were before the news of an acquisition broke at the back end of the Q1. But as I said, with Tesla, what's quite staggering is their share price jumped on the news that they weren't going to no longer buy Twitter. So, you know, it's like kind of like a role reversal, or a good news, let's say, for one company or bad for another. So it'll be interesting to see what Twitter and Tesla can do in the next few months as well. So, but
yeah,
obviously
they're really worried that Elon was going to sell more shares, but he already sold $8 billion worth of his own shares previously. I mean, there's some rumor that that's what he was doing. Like he did this whole Twitter deal so that he could sell 8 billion of his shares and it wouldn't affect the price. And if he did do that, he pulled it off, then, you know, that turns out to be kind of a pretty good move too.
Exactly.
Even if he ends up having to pay the $1 billion in the breakup fee, well, that's a tax write-off, and he's at the top end of the tax bracket. So it's not for him. It wouldn't be $1 billion that he would end up paying; it'd be less. So if he can get $8 billion in shares, and then end up paying what 700 million in taxes, it still is kind of a decent move for him to get an additional amount of spending money.
Exactly.
So that might be the thing that's going on. So you know, we don't know what's going on inside of his head, and so, you know, it's always a little extra risk trading based on guessing what one person is thinking.
Because that one person could really shake up the stock quite significantly, like we've seen in the past. So
yeah. Though I still think
good.
the deal will probably, there's a good chance the deal will go through, but probably at a lower price. I mean, this sort of thing has happened previously with a bunch of others. I just thought of one that happened quite recently, and what happened is that, right, it was Tiffany. They sued the company. One of the companies wanted to pull out, and so then they sued, and then they agreed to a lower price, because, I mean, it doesn't really make sense if, you know, you offer, you know, the original deal is for, say, 100 and the thing is actually worth 50, you know, trying to force them through to 100, and no one really says so, but you could probably get maybe 60. So the question is, how much is Twitter really worth? And then maybe Elon's going to end up paying a little bit more than that, and then that's what the actual price is going to be. So, you know, maybe $40, or, well, he really likes 42. Everyone's saying he's going to want to do it at $42, so that might be the actual real price that goes through.
Exactly. Basically, it'll be a bit less than what it is now.
Yeah,
from the first price.
But I don't think anyone who thinks that the price is going to go at 57 is probably not going to work. It's much more likely to not happen than it goes through at 57.
Exactly. So moving on to the next stock, and one that I sometimes can't pronounce correctly, Nvidia.
Oh, Nvidia.
Nvidia, yes, that's the one. Glad you corrected me there. So we've seen a bit of a drop in stock price since, again, from the second quarter. In fact, a lot of stocks from the second quarter have actually not done very well in their pricing. But
Thanks, Fed.
Yeah, so exactly. So where do you see this company going? Because obviously we've got it has taken a bit of a tumble in recent sessions, but we've have had a little bit of a spike to the upside. So it's a little bit hit and miss in the last few sessions. Well, since we started Q3, actually, we've had a bit of an upsurge, but the Q2 was probably one to forget about, would you say?
Yeah, it seems to be, but that seems to be mostly like following the general thread. I was trying to say theme and thread at the same time. You know, the same theme for most of the tech stocks. They've been on the downside, and Nvidia wouldn't be very much different from that. But the thing is, they are a semiconductor and a chip maker, and so the big issue that we have are chips. And so since they had the issue with graphics cards prices being thrown out of whack because of the whole mining thing, but now ETH is moving away from of proof of work and so now you have a lot less use of graphics cards for mining. But they did a substantial amount of investing in cloud computing, and cloud computing has been really going really well for a lot of companies. And so they're even moving kind of away from gaming. So which would be for a period of time bad for them, because there's a lot of retail sales available for people buying new gaming rigs, and they didn't hike prices, but that didn't allow them to get into the cloud, the supplying of the infrastructure for cloud. So you see, SAP and Amazon and what was the other one? Software. They all had a significantly really good performance in the last couple of quarters due to cloud. Well, in order to provide cloud services, they have to buy the infrastructure, and they're buying it from Nvidia. So Nvidia seems to be getting into a better position, and they might be, particularly if the Fed stops hiking rates, they could be in a really good position to recover going forward.
Yeah, I mean, just touching upon that, the chip shortages that we've seen in the last couple of years, it have affected not only these companies, but also the indices as well that they make up as well. So it is something to maybe keep an eye out for, because we are looking now likely that a company like Nvidia, it could bounce back in the second and the third and fourth quarters of the year. So it's something to kind of look forward to again.
Particularly if there's a lockdown, as you mentioned previously. Where Nvidia had their big move up was the last time there's a lockdown. So there's more of that, then they could have a return.
Exactly, yeah. So moving on to our next stock that we've highlighted is, again, I hope I get this pronunciation correct, Palantir.
Yeah.
Thankfully you're here with me.
Tolkien books.
Yeah, exactly. So they're allegedly, their earnings report the last time around wasn't so great, but they are allegedly striking a major contract in the UK.
Right.
Could that possibly elevate this stock price? I mean, again, from where the second quarter started, we have seen a bit of a decline, even though we are in a slight bullish channel now from the recent bottom that we saw, which is quite progressive. But we have seen this kind of collapse in the first part of the second quarter of this year. So would you say that Palantir could be bouncing back anytime soon?
Well, that seems to be the hope. I mean, they've been following the same problem that all the tech stocks have, and then also they're really into defense spending, particularly in the U.S. And so because of the way with the new administration isn't really putting all that much emphasis on defense spending, so that's also adds to their woes. But they're moving out of being mostly defense and going into large big data programs for civilian uses, and that allows them a much bigger market. And so that could be the opportunity. Right now they're really trying to get into getting that contract that you mentioned with the NHS, and if they get that, it's equivalent to, I think, 1/4 of their total sales for 1 year. So that would be a significant boost for them. But then, of course, this is a matter of whether it's going to be decided by the UK government, whether they're going to do it. And it's not really based on technicals or the fundamental position of the company. So there's a chance of a bounce higher, or if they don't get it, then they could continue moving down lower. So there's a risk of it, but there's also pretty good growth potential if they actually get it, because the stock price could move because of the announcement of the contract, but then that contract is going to last for at least 5 years, and then that also allows them the opportunity to bid for other contracts in the UK, in the United States, in Europe. They become more international, so that could also keep the stock price going higher forward if they actually get it. So it's a more of a, there's an opportunity here, but you have to pay attention to get in at the right time.
Yeah, sure. I mean, it's looking a little bit more optimistic for this particular stock than others we've just mentioned as well. It is on a kind of upward trajectory slightly, and there are things in the pipeline what can actually lift it, or potentially lift it as well. So it's not all doom and gloom, at least for this particular stock, Palantir. So
yeah, it's also another thing that, like, it isn't something that most people will be if you're paying attention to Palantir, you know that or you're paying attention to the healthcare situation in the UK, then you'll know about it. But if you're like a general trader to just looking at the movement of stocks, you wouldn't know about necessarily that contract. So there's more of a chance of a bigger move from it.
Yeah, absolutely. So moving on to Rio Tinto now. Very different stock, because it is actually usually quite choppy, and we do get a few uncertainties in the market for Rio Tinto. So with that being said, I mean, it's multinational mining company as well. I mean, do you see mining companies really breaking out in the back end of 2022?
Well, that depends on the recession, essentially, but there is a good chance of it, because what we really need are raw materials, and we need specific raw materials, which Rio Tinto is really good at producing, one of them specifically being copper. And then, of course, you also had this period of, for the last 5 months, 6 months, where China has been having economic problems because of the latest COVID outbreak. Once they recover, then they're going to be also needing more metallurgical coal to restart their steel plants and to really push steel production. So there's a good chance that Rio Tinto could stand to benefit if China gets in the upward trajectory, and the recession isn't all that bad, because if we're going to, this is a strong push to get us into using electric vehicles and to go to renewables and all that. What that means is, if we're going to be moving away from fossil fuels, we have to transmit electricity. Electricity requires significant amount of either copper or aluminum, and Rio Tinto does both. So they're in a good position.
Yeah, definitely. I mean, I've just highlighted on the chart the recent cluster of candles that we've had, because I mean, since if we're going back to just again almost to when the second quarter started, we've had this kind of decline, potential breaks out of this kind of descending channel, but we've had this decline, and it seems like a full bear market is on the swing now. But since we've moved out of this, I'll just extend this a bit longer, because we have moved out of it, but we're back inside it now. It is a little bit precarious for Rio Tinto, because it has got the worrying sign that it could actually fall lower, and this could be yearly lows. I mean, the last time we saw this was at the back end of 2020, obviously when the pandemic was in full flow. Before that was in the middle of 2020. So if it does start falling even lower, we've got kind of like pre-pandemic levels here that we don't really want. Obviously, we don't really want to get to for Rio Tinto, but it is like the reasons you've just given us now and the examples. It is a vast awareness that traders have to get into their heads that we could actually start slipping lower in the near term, at least.
Yeah, this particularly with anything that's supplying raw materials. If you have a recession coming up, then people are going to be consuming less. So, but if the recession is avoided, or number two, you just wait through the period of the recession. Recessions don't last forever.
Yeah.
Hopefully, the Great Depression notwithstanding, but reasonably speaking, maybe after you get a recession for a couple quarters, and then after that, there's going to be a resurgence in demand for particularly the things that people really are going to be needing around electric cars and solar panels and such. They're going to require a lot of new raw materials. Well, they're not new, but they're going to require us to produce a significant more of certain raw materials, and Rio Tinto is well positioned. And another one, of course, is Antofagasta, because their main thing is copper, so they're
Of
kind of
course.
rival. So either one of those, it would be a good thing to keep an eye on.
Of course, definitely. And lastly, on the stock front, and the last instrument we'll look at today is Ryanair. Now, we wanted to kind of just ask, get your outlook, let's say, on the airline industry in general. Okay, we're looking at European airline at the moment, Ryanair, because we've had such a bad summer of discontent with cancelled flights, not having the right amount of employees for not only working on the airline, but working at airports as well. Obviously, since COVID has come along, a lot of people have a few more job offers in the pipeline, and obviously a lot of people you don't need to work for airlines anymore, don't need to have shift work. And obviously this is affecting the airline industry as a whole, because a summer period where there should be so much profitability in airlines, it seems that they're cancelling flights in Europe has really started to have transportation issues for not only Europeans, but for the rest of the world. So how do you see the airline industry going? And obviously, speaking about Ryanair, how do you see their outlook for the rest of the year?
Well, it'd probably take a little while to get readjusted, but eventually they are going to get readjusted. So the question, but I mean, one of the thing is, it isn't just the airlines, of course, it's also the trains and buses that are also have pretty much exactly the same problem. So it isn't like, oh, people will not be able to not fly, they'll start taking trains. It's like, you're going to have the same problem with trains. I went to Vienna a couple of days ago, and I was on the train was delayed, so I ended up talking with somebody who missed his Ryanair flight.
Okay.
And he tried to get a train, and the train didn't arrive on time either. So he's like, it isn't like you get a better option by switching out. So the thing is, the airlines that have the least overhead are probably going to be the ones that are best off in dealing with that problem. So like the flag carriers, they have to fly certain flights, and they have bigger planes. And so they're going to be suffering more than sort of the more nimble airlines that have smaller planes. If you have a smaller plane, then you have less problems with losing baggage, and you have less problems with moving people around and such. So Ryanair might be in a better position until that gets sorted. And so right now it's probably in the worst, because July is when everyone goes on vacation.
Exactly.
A little bit of, and then August too. But by September, it might end up being finally getting better, and then their results could start improving. The amount of cancellation can go down, and then so it maybe have patience through a month or two. But the thing is, the market will probably move before that actually happens, so it might actually be getting near the bottom, and airlines would be a good option soon. Hopefully.
I was going to say they could start bouncing back pretty soon on that regard. I mean, I've highlighted on the chart that we didn't see these levels since the pandemic did begin, or the middle of the pandemic. And obviously, I believe this is when the first lockdown actually ended, in the middle of the summer, when the summer season was starting in 2020.
Oh, right,
which is why we've seen such an ascension on the price. But since then, we've seen such a bad year so far for not just Ryanair, but a lot of airline stocks as well. As I said, cancelling flights, and obviously the shortage of staff that they've had due to the cancellations. But there's always the bounce back ability, and making sure that we're looking at the best opportunities in the markets and seeing what's out there. So, I mean, the stocks that we picked out on the quarterly report, we wanted to highlight what the best potentials are, and obviously to look out for the next 3 months. Daniel, you're quite a connoisseur with the earnings season as well.
The thing that gets me plenty stressed out. Thank you.
Exactly. Just to touch upon that before we finalize the quarterly report in closing, where do you see the earnings report going? I mean, I know there's a few big companies that have already submitted their earnings report so far for the third quarter, but do you see it as a successful earnings season so far, or could it have been better?
Far, the thing is, this coming week is probably the worst in terms. Well, I should probably say the best. It's the worst for me because it means I have the most work, but it's when we get most of the reports of me coming out this week. So pretty much by the end of this week, you will know where the where earnings season has been going. But mostly it's been, most of the companies that have been reporting so far, they've been reporting better numbers, but still, but lower volumes, as I mentioned earlier. So you could see the stocks moving up higher, but that would be kind of like in nominal terms, because the value of the dollar has, well, there's been, significant amount of inflation has been going on, and that's eating up their stock price.
Right.
So the companies have been doing well. So if you're looking at it in nominal terms, they've been doing relatively well. Mostly they've been able to push their prices over to the consumers. But what's been concerning, that a couple of companies, particularly PepsiCo, which is kind of more relevant because the Frito-Lay division is a consumer good that people can stop. It's really easy for people to stop eating chips. So their volumes are starting to go down. So of the companies that like the companies that might start facing problems with being able to push higher prices through and push their higher costs through, you're starting to see that in some of the companies. And so we might be reaching, the period of demand destruction when you have inflation, and that could again be another sign of a recession.
Of course, yeah.
Kind of repetitive to say recession all the time, but
yeah,
that's kind of where we're going.
Exactly, that's what I mean. It's inflation, recession fears. I mean, this is what's made up the last quarter, and probably will make up the next 2 quarters as well, as we close out 2022. Okay, Daniel.
The thing is, when everyone's talking about recession, that usually means it's kind of close to getting over. So it might be near the bottom, really. So that just to put a bit of silver lining on at the end. Finish on a positive note.
Yes, exactly. I'm glad you pointed that out as well. Okay, great. Well, that concludes this quarter report, the insight, the engagement that we've had. Daniel, thank you once again for joining me for this. It's been a pleasure.
No, thanks for bringing you on. It was quite fun.
No problem at all. And what we'll do next time is we'll prepare another quarter report for our traders to make sure they're getting the full investment outlook of the last, well, it will be this quarter and obviously going into quarter 4 next time around. So this video will also be posted on our blog and on the landing page. So feel free to comment or add any questions you might have to the video, and we'll get back to you as soon as possible. So once again, Daniel, thank you very much for joining me, and we'll speak again next time.
Yeah, take good care, and everyone else also take good care. Happy trading.
Thanks again, Daniel. Bye for now.
Take care.